Well, this week's Market Monitor has 3 picks he says are durable in the face of changing tax policies. Last time he was on, look at these guys. Cisco up 21%. You like that? Johnson & Johnson 17%. Northrop Grumman 22% higher. Andy Kapyrin is Director of Research at Region Atlantic. Andy, welcome back. Nice performance there. Let's talk broadly about what we expect tonight is going to be a tax reform bill passed by a tax cut bill passed by the Senate. Let's say it happens. How much are lower corporate tax rates going to boost American corporate profits?
I think in a big way, but I think the more important question is who's it going to benefit more? I think what we've seen this week is the Dow Jones Industrials have done much better than the more tech-heavy NASDAQ, and that has everything to do with who benefits. Industrials tend to have capital expensing costs. They tend to have more traditional business models, higher tax rates. Tech companies tend to be able to park their profits abroad, pay much lower taxes, so tax reform doesn't really give them a big boost. In fact, it might actually hurt.
And some of the small companies that don't have those big capital expenses might help small companies as well.
That's right.
Let's get to your picks. They are interesting. We've got a beer, a package delivery company, and a gas company or an oil company. Let's start with the beer company first.
Sure. So the company I'm recommending is Molson Coors. Molson Coors is an interesting one because it's been struggling so far this year. It's one of the underperformers within beverages, and beverages itself is a hard industry. Why Molson Coors then? Molson Coors is at a turning point. One, they recently merged. Molson Coors were separate companies last year. That helps bring the cost structure down. The other thing that they're doing is they're pivoting towards more niche beer brands and away from the
big broad Coors or whatever.
Exactly. So Blue Moon, for example, is one of their brands that's actually growing as opposed to stagnating.
Oh, I like that one. That's actually a good one.
It is a very good one.
So you want beer, you got to have it delivered. FedEx.
That's right. So FedEx describes itself as an e-commerce company on steroids. That's really what they are. They benefit from a lot of the trends in consumer shopping, which is we want to have it delivered to our door. We don't want to go to the store anymore. But they can actually do it profitably. Amazon doesn't make money off of delivering packages to your door. FedEx does. That's a very important difference and makes me bullish on them.
So if you have lots of trucks and planes, you need the fuel to run them. Total is your choice in that area.
Total. I like European oil giants much more than American ones.
Why?
Well, one is you don't have to worry about what tax reform does. Tax reform could be good, it could be bad. The other reason is they're cheaper. After a number of difficult years in Europe and abroad generally, they've gotten materially cheaper than the Exxons and Chevrons of the world. Makes Total a bargain.
Andy, continued good luck to you.
Thank you,
so
Tyler.
We've got Total, FedEx, and Molson Coors.
That's right.
Andy Kapyrin, thank you.